Good morning, options traders, and I wanted to post a quick video about the hidden benefit of vertical spreads. Yes, you've heard me talk so much about vertical spreads in the past, and there's a reason. They are extremely powerful. And unfortunately, new traders overlook them because they say, oh, I don't like them because they limit your upside. And that's true, but all strategies are about trade-offs. But there are so many benefits of verticals that people overlook. So let me show you one in particular. So first, recall what a vertical spread is. You're going to buy a call or a put, and you will sell a call or a put with the same expiration. Remember that they both have to be calls or both options have to be puts, but not one of each, at least for a vertical spread. So for instance, let's say that you buy the $100 call, you sell the 105 call. We would say that you are long the 100-105 vertical spread. You're going to pay something less than the difference in strikes. So in this example, maybe anywhere from below $1 to $2 or $3, $4. And the maximum it could ever be is the difference in strikes. So here it would be a maximum of $5. So once again, this is why so many traders kind of overlook the vertical spread. They say, I don't want to limit those profits because I think this stock is going to take off for the moon. And that's fine. But the problem that I have with that is that most people trade with price targets. They don't hang on to these things forever, trying to get 20, 30, 40, or $100 worth of profits. A lot of people are very short-term traders and they trade with targets. So again, they're going to have these trading targets and they could be in terms of dollars or they could be in terms of percents. But regardless of how you want to measure them, spreads can help you reach these targets easier. So for instance, let's say that the stock is at 102.50 and we have 30 days to expiration. And I chose these to use a pricing model so we can kind of use fair prices. Volatility is 30%. And if you put those into a pricing model, you'll see that the $100 call is worth $486 and the 105 call is worth $244. So if you buy the 100 call and sell the 105 call, then we would say that you bought the 100-105 vertical for $2.42. That's just taking this $486 price, the amount you spend, and subtracting off the $244 price, the amount you receive from selling the 105 call. So one of the reasons I chose this example, and there's a lot of different ways we could structure it, but I've talked about in previous videos about using spreads that trade at discounts or at premiums. And when the stock price is right between your strikes, such as we have here, we've got the stock at 102.50 with the 100-105 vertical spread. So the stock is sitting dead center between them. And when you do that, you'll find that that spread trades for just about intrinsic value. So what I mean by that is if you have the $100 call and the stock is 102.50 at expiration, that call would be worth $250. And that's about what you're paying for it. So there's not really any premium attached to this. There's not really extrinsic value in a sense that we have to worry about. So notice that we are paying 49.8% of the $100 call, just a touch under 50%. Because we're paying $242 for the vertical, if we chose the $100 call by itself, we would pay $486. So for this video, I'm just going to assume that it's exactly half price, but it's actually just a touch less. All right, so that's going to be our setup to see some of the advantages. So let's say that a trader has a target of 100% profit. And it doesn't really matter which number we pick, it's just going to be a little easier to do the math. So no matter what they pay for the $100 call or for the vertical spread, they'd like to double their money. And again, this is the way that a lot of traders set up their positions. So if you bought the $100 call for $486, you would need to sell it for $972 in order to double your money. And that means the stock would need to be at 109.72 at expiration, right? If the stock is 109.72 at expiration, the $100 call is worth the $9.72 of intrinsic value, and that would allow you to double your money. However, the 100-105 vertical was trading for $242, and that means you'd need to sell it for $484, which means the stock would have to be at 104.84 at expiration. And if that happened, the 105 call goes out worthless because it's out of the money. That's the call you sold. But your $100 call is just intrinsic value of 484. So that would allow you to double your money. So notice these two prices right here. Which is more likely for the stock to go to 109.72 or to go to 104.84? It's a whole lot more likely that it hits 104.84, and that means you've got a much better chance of doubling your money. Now, you might say, well, how much better? Well, there's a little trick you can do by going into a pricing model and making the strike price equal to the necessary stock price. So if we put a strike of 109.72, you would see that it would have a delta of 22. And that means there's a 22% chance that this stock is going to be at this level or above. What about 104.84, this number right here? If we pretend that this is the strike, there's a 41 delta. So you can see that we've almost doubled our chances in relative terms for doubling our money. Now you might say, well, wait a minute, the dollar profits are different. Well, that's true, but if somebody wants to define their trades in terms of percentages, that's always going to be the case. But let's address it. What about the dollar profits? The person that buys the $100 call for $486 and sells for $972 has a profit of $486. That's what we mean by doubling your money. You paid $486 and you pocket that same amount. The 100-105 vertical spread purchased for $242, however, and gets sold for $484 leaves you with a profit of $242. So you might look at this and say, well, my profits are actually half of that as the person who just buys the long call, even though the percentage terms are the same. Well, that's true, but remember, the vertical spread cost half as much. You could buy two spreads and invest exactly the same amount of money. So the hidden benefits are numerous with vertical spreads. By purchasing two vertical spreads, you've invested exactly the same amount of money, but it also allows you to scale in, which just means that you take multiple chances to build your position. So because you're buying two vertical spreads, maybe you start out buying just one. And if it goes against you, you might say, you know what, I still like it, let me buy the second one. Now you've got even less money invested, but in all cases, you have higher probability for success. Now, are there trade-offs? Yes, there are always trade-offs. And those are one of the things that I always teach in every class and every strategy. You have to understand what the trade-offs are. If anybody teaches a strategy without showing the trade-offs, they're really doing you a disservice. So the trade-offs here is that the vertical spread is going to arrive at those profits slower. And that's because you've got areas of positive gamma and negative gamma, but those are topics for a different video. But for right now, just keep that in mind. Vertical spreads can allow you to invest the same amount of money, allow you to scale in, and give you much better probabilities for success. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.